A lot of traders run into the same frustration with Dow Theory. By the time it gives you confirmation, the market already feels like it has moved. The rally is no longer cheap. The sell-off is no longer fresh. And now you are stuck asking the same question every trader asks at that moment. What is the point of confirmation if it always feels late? That is the real issue. Not whether Dow Theory is famous. Not whether it is old. Not whether it has value in market analysis. The issue is that most traders secretly want two things at the same time. They want confirmation, but they also want early entry. And those two are not the same job. So in this lesson, we're going to break down why Dow Theory feels late, what it actually helps you do, where traders misuse it, and why many people judge it unfairly because they expect it to solve a problem it was never designed to solve in the first place. The reason Dow Theory feels late is simple. It is a confirmation framework. And confirmation always happens after evidence appears, not before. That sounds obvious, but traders still fight this reality all the time. They want a method to prove the trend is real, but they also want that proof to arrive near the turning point. That is where the disappointment begins. If you think like an early entry trader, Dow Theory is going to feel slow. If you think like a major trend trader, it starts making a lot more sense. That distinction matters. Because many traders criticize a major trend confirmation tool for not behaving like a tactical trigger. That is like criticizing a map because it does not tell you the exact second to hit the gas pedal. The map and the trigger are not doing the same job. Dow Theory is trying to answer a big question first. What is the market's primary direction? That is a very different question from, where exactly should I enter today? Where exactly should I place my stop on this intraday setup? Should I buy this pullback right now? Those are lower-level trading questions. Dow Theory works at a higher level. It is trying to reduce the chance that you mistake noise for a real trend shift. That means it needs evidence. It needs broader confirmation. And the moment you require broader confirmation, you automatically give up some speed. That is the trade-off. Less early, more confirmed. And traders need to be honest about that trade-off. Because once you understand that, you stop attacking the method for the wrong reason. A method can absolutely be late and still be useful. Late does not automatically mean wrong. Late does not automatically mean weak. Late often means more selective. The real question is not, is it early? The real question is, what job is it trying to do? Most traders misuse Dow Theory in one of three ways. First, they expect it to call the turn. They want it to catch the bottom close to the bottom, or catch the top close to the top. But confirmation-based frameworks usually do not earn their keep at the turning point. They earn their keep by helping you avoid acting too early on something that is not yet proven. Second, they expect it to manage intermediate swings. This is where the frustration gets stronger. A trader sees a pullback, a bounce, a failed breakout, a reclaim, or a rotation, and wants Dow Theory to provide tactical clarity inside that structure. But that is not really its strength. It is not built to help the trader who is operating inside every swing of the intermediate move. Third, they expect it to remove uncertainty completely. That is another trap. Traders often talk about confirmation as if it should eliminate doubt. It does not. It reduces certain kinds of doubt, but it does not remove judgment from market reading. There can still be ambiguity. There can still be messy transitions. There can still be periods where the signal is not clean enough for the trader who wants immediate clarity. This is the part traders need to get clear on. There are at least 3 different jobs in technical decision-making. Job 1. Identify broad market direction. Job 2. Find a tactical entry. Job 3. Manage the trade. Dow Theory mainly belongs to Job 1. But many traders try to force it into Jobs 2 and 3. Then they complain that it is late, vague, or not actionable enough. Of course it feels that way, because broad trend context is not the same as execution. Think about it like this. A major trend framework can tell you that the market environment is bullish enough that selling every rally is a bad idea. That is useful, very useful, but that still does not tell you which pullback is worth buying. It does not tell you whether this breakout is clean or extended. It does not tell you whether your stop is too wide, too tight, or placed in the wrong location. That is a different layer of trading. The moment you separate those layers, your thinking gets cleaner. Now you can use broad confirmation for context and use other price behavior for execution. That is a much more mature way to trade. This is where the criticism becomes very understandable. If you are a swing trader, timing matters a lot more. You do not just care whether the market is broadly bullish or bearish. You care whether this leg is exhausted, whether this pullback is controlled, whether this breakout has room, whether participation is expanding or drying up, whether the move is extended relative to its recent structure. A swing trader lives inside the intermediate move. And that is exactly why a broad confirmation framework can feel unsatisfying. It may help you avoid trading against the primary tide, but it may not help you exploit the best tactical part of the move. So when swing traders say, "This feels too late," they are often not wrong. They are just speaking from a different problem set. That is the key distinction. The method is not necessarily failing. The trader may simply be using it at the wrong layer. If your trading horizon is shorter, your decision tools usually need to respond faster. Not because the broad trend is irrelevant, but because execution quality matters more inside the shorter window. Here is what many traders overlook. Even if Dow Theory gets you in later, it may still keep you aligned with the larger move more effectively than early guesswork. And that matters. A lot of traders lose money not because they were late, but because they were early in the wrong direction. They were trying to bottom pick before the market had actually turned. They were trying to fade strength before the trend had actually rolled over. They were acting on anticipation instead of confirmation. So yes, a confirmation framework may cost you the first portion of the move. But in exchange, it may save you from a long list of bad early decisions. That is not a small benefit. There is a difference between missing part of a move and being trapped on the wrong side of the market. Many traders would improve immediately if they stopped obsessing over catching the first piece and started respecting the value of participating in the cleaner middle. The middle of the move is often where the real money is made anyway. Not the fantasy entry. The proven move. Now let's be fair. One of the reasons traders get frustrated is that broad confirmation frameworks do not always produce the clean certainty people imagine. Sometimes the market is messy. Sometimes the structure transitions gradually. Sometimes the evidence is incomplete. Sometimes the trader still feels stuck between caution and commitment. This matters because traders often hear the word confirmation and assume that means clean confidence. But markets are not always kind enough to do that. There are periods where the bigger picture is not yet decisive enough for a strong conclusion, while the shorter-term chart is already moving. That creates tension. The faster trader sees opportunity. The slower framework still wants more proof. That gap is uncomfortable. And that is another reason people say Dow Theory feels late. Not just because it confirms after the move begins, but because during transition phases it can leave the trader waiting while the market is already doing something. That is a real limitation, and it should be admitted clearly. A good educator does not defend a method by pretending it has no weaknesses. The stronger lesson is this. Know the weakness, then use the method where it still has value. So how should a modern trader think about Dow Theory? Use it as context, not as your complete trading plan. Use it to answer. Am I dealing with a market that is likely in a broader uptrend, broader downtrend, or unresolved transition? That alone can improve your decision-making a lot. Because once broad direction is clearer, you stop forcing trades that fight the larger environment. You become more selective. You stop confusing countertrend noise with genuine structural change. But after that, you still need a second layer. You need your actual execution logic. That could be price action. That could be support and resistance behavior. That could be trend line behavior. That could be pullback structure. That could be volume confirmation. That could be breakout acceptance or rejection. That could be whatever tactical framework you personally trade well. But that second layer must exist. If you only use broad confirmation, your entries may be too blunt. If you only use short-term triggers without context, your trades may become too random. The better approach is layered thinking. Broad context first. Execution second. Management third. That is how you modernize the lesson without losing the truth inside it. Here is a rule that will help beyond this topic. Never judge a method by the job you wish it did. Judge it by the job it was built to do. That one shift in thinking can save traders a lot of confusion. If a method is designed to confirm major direction, judge it on whether it helps with major direction. If a method is designed for timing, judge it on timing. If a method is designed for trade management, judge it on management. The trouble starts when traders want one framework to handle everything. Trend bias, entry timing, stop placement, trade filtering, and emotional certainty. That is too much to ask from almost any single tool. So the real maturity in trading is not finding one perfect method. It is learning how each tool fits into the decision stack. That is the deeper lesson here. If Dow Theory feels too late to you, that does not automatically mean you should throw it away. It may simply mean you are asking it to do a job it was never built to do. If you are a swing trader, take the context but do not expect it to hand you precision. If you are trying to identify a major market direction, its slower nature may be exactly why it helps. If you keep feeling torn between confirmation and entry timing, the answer is probably not choosing one over the other. The answer is separating them. Use broad trend logic to decide what side of the market deserves more respect. Use tactical chart reading to decide when the trade is actually worth taking. Use trade management rules to control risk after you enter. That is cleaner. That is more realistic. And that is how you stop blaming the wrong framework for the wrong problem. So yes, Dow Theory feels late for most traders. But the deeper truth is this. It feels late because it is trying to confirm something bigger than the average trader is actually trading. And once you understand that, you stop treating it like a failed entry system and start seeing it for what it really is. A broad market filter with real value, real limitations, and a role that only makes sense when it is placed in the right layer of your trading process. That is the lesson. Not every useful tool is early. Not every late tool is useless. And not every trader problem should be solved by the same method.